in October. The increase was expected and primarily reflected an energy-related upward base effect. Food price inflation edged down to 2.8% and services inflation to 3.9%. Goods inflation went up to 0.7%. Domestic inflation, which closely tracks services inflation, again eased somewhat in October, but at 4.2%, it remains high. This reflects strong wage pressures and the fact that some services prices are still adjusting with a delay to the past inflation surge. That said, underlying inflation is overall developing in line with a sustained return of inflation to target. The increase in compensation per employee moderated to 4.4% in the third quarter from 4.7% in the second. Amid stable productivity, this contributed to slower growth in unit labor costs. Staff expect labor costs to increase more slowly over the projection horizon as a result of lower wage growth and higher productivity growth. Moreover, profits should continue to partially offset the effects of higher labor costs on prices, especially in the near term. We expect inflation to fluctuate around its current level in the near term, as previous sharp falls in energy prices continue to drop out of the annual rates. It should then settle sustainably at around the 2% medium target. Easing labor cost pressures and the continuing impact of our past monetary policy tightening on consumer prices should help this process. Most measures of longer-term inflation expectations stand at around 2%, and market-based indicators of medium to longer-term inflation compensation have decreased measurably since the Governing Council October meeting. So let's look at the risk assessment. The risks to economic growth remain tilted to the downside. The risk of greater friction in global trade could weigh on euro area growth by dampening exports and weakening the global economy. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by geopolitical risks such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could disrupt energy supplies and global trade. Growth could also be lower if the lagged effects of monetary policy tightening last longer than expected. It could be higher if easier financing conditions and falling inflation allow domestic consumption and investment to rebound faster. Inflation could turn out higher if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Greater friction in global trade would make the euro area inflation outlook more uncertain. Financial and monetary conditions now. Market interest rates in the euro area have declined further since our October meeting, reflecting the perceived worsening of the economic outlook. Although financing conditions remain restrictive, our interest rate cuts are gradually making it less expensive for firms and households to borrow. the average interest rate on new loans to firms was 4.7% in October, more than half a percentage point below its peak a year earlier. The cost of issuing market-based debt has fallen by more than a percentage point since its peak. The average rate on new mortgages at 3.6% in October is about half a percentage point lower than its highest point in 2023, even though the average rate on the outstanding stock of mortgages is still set to rise. Bank lending to firms has gradually picked up from low levels and increased by 1.3% in October compared with a year earlier. Debt securities issued by firms were up 3.1% in annual terms, which was similar to the increase in the previous few months. Mortgage lending continued to rise gradually in October, with an annual growth rate of 0.8%. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks remain resilient, and there are few signs of financial market stress. Financial stability risks, nonetheless.
All right, let's get over to President Trump. He is speaking now at the New York Stock Exchange. You can continue watching the ECB, if you like, on your Bloomberg terminal using Live Go. Here's President Trump.
Time Magazine getting this honor for the second time. I think I like it better this time, actually, but we did a good job. We had a great first term, despite a lot of turmoil caused unnecessarily. But the media's tamed down a little bit. They're liking us much better now, I think. If they don't, we'll have to just take them on again, and we don't want to do that. But I do want to thank Time Magazine. I've been on the cover many times. I don't know who has the record, but I can only probably talk well about 25% of the covers. 25% are great. The others I just sort of hide. But it's been an honor, and every time it's an honor, I will tell you. And thank you very much for doing it. And thank the whole group at Time. Really very professional people. Thank you very much. And to Jeff and all of the people from the New York Stock Exchange. He knows how much I like it because many years ago I bought a building across the street. I wasn't going to buy it. Then I said, you know, it's right next to the New York Stock Exchange. I'm going to buy it. We've had great success. 40 Wall Street, we've had tremendous success with it. But you've really had success with the New York Stock Exchange. It's an incredible group of people. And Jeff, you have done an incredible job, you and your group. And what a beautiful speech you made. Thank you very much. I was some introduction of all of us. But we've gone up since the election. I was just told by Scott, everybody said, you have to pick Scott Bessent. He has to be the one chosen for Treasury. Where is Scott? Let's see. He's around here someplace. He's around here. He told me we picked up $3 trillion since the election day. And I said, well, that's good, but what about before the election day? He said, we picked up some money there because they thought you were going to win. I said, I like this guy. He's going to be my Treasury Secretary. But it's true. I think we're going to have a tremendous run. We have to straighten out some problems, some big problems in the world. When we left, we didn't have any of these problems. We didn't have Russia with Ukraine. We didn't have Israel October 7th. We didn't have the Afghanistan disaster. We didn't have inflation. We had no inflation. And we had a very strong economy. And we're going to do that again. But I think we're going to even up it because now we have experience that we didn't have. Now I know everybody. You know, when I first came in, we came down, Melania and I, a great first lady, who's very popular, by the way. She rang in. She rang in the bell. She rang in the bell. But we came down and we're driving down Pennsylvania Avenue, and it was so beautiful. I said, you know, I've never done this before. I didn't know anybody. I got to the Oval Office, and I'm picking all these big positions, and I didn't really know the people in Washington, but boy, did I get to learn fast. And now we do, and I think we have an incredible staff behind me and others that aren't here. And we're going to do a fantastic job. We're going to create the incentive theory again. In fact, I just announced yesterday, I didn't announce it for this reason, but anybody investing $1 billion or more gets a very expedited approval process because, you know, the approvals, when people come into the country, it takes them, in many cases, 14, 15, 16 years to get the approval. We have Lee is around here someplace. He's in charge of the environment, and that's Lee Zeldin, who ran an incredible race for governor in New York, was a very, very successful guy before that. He was a great congressman, and he's a fantastic lawyer. He's in charge of environmental, and we'll try and push him as much as possible to get those permits very quickly. Like a nuclear power plant, I would say a week would be enough time. What do you think? Is that okay? We're going to get fast approvals, and it's great that we have Lee and all of the people behind. They're all stars in their own way. But it is an honor, and this is a double because usually they don't coordinate the Man of the Year or the Person of the Year with the ringing of the bell. And brilliantly, you picked them both at the same time, and you were all friends, and you said, let's do it. And it takes one trip. It doesn't take two trips. That's okay. We like to save. We like to be able to do it properly. But this is a special group. So many friends in the audience, too. John, great job you've done at ABC. I'm really proud of you, and you've been so nice to me. Otherwise, I wouldn't actually acknowledge you at all. But you have been. That really is. It's a terrific job you've done. But again, I want to thank you. We're going down to ring the bell now, and I could just say that the economy, I believe, is going to be very strong. We do have to solve some problems. We have wars going on that we didn't have. We have a lot of things happening that we didn't have that would have never happened. They would have never happened, but now they have happened. And I want to get them solved. We have to get them solved because ultimately the power of weaponry today is the biggest threat we have, in my opinion. It's not some of the other things that you read about. It's the power of weaponry. The weapons are so powerful, so devastating. And I rebuilt our military. I got to know every one of them, including nuclear weapons. I hated to do it. Actually, I hated to do it. But we did some nuclear weapons that are so devastating. It almost makes you very sad as you get them and as they come online. It makes you very sad because you know what the purpose of them is, and you just hope to God that you never have to use them. Because if you do, the world will never be the same. So we have to be very, very smart. We have to be very sharp. We have to be very special to do a job. And I think we'll get it done. And I think we're going to get a lot of people in the room. We've seen it. We were in France where President Macron did a fantastic job with the cathedral, an absolutely fantastic job of Notre Dame. And it was beautiful. The opening was the opening, and I just got back, and it was something really beautiful. And a lot of world leaders there. We had about 80 world leaders, different countries, and they were all coming together. They all wanted to meet us and meet me as representative of the U.S., and there was a lot of goodwill. But we're going to get some really tremendous goodwill. I was even thinking about inviting certain people to the inauguration, and some people said, wow, that's a little risky, isn't it? And I said, maybe it is. We'll see. We'll see what happens. But we like to take little chances, but that's not a bad chance. Here's a gentleman that's going to do a great job at HUD. Good luck, my friend, right? He's going to be a he's been my friend for a long time. It's nice to see you. I haven't shaken his hand yet. Come on. Congratulations. Yeah, thanks. Really, you're going to be great. And Ben Carson is your biggest fan in the world. You know that. Ben has been with us for a long time and he's done a fantastic job. Thank you. Good. So, ladies and gentlemen, go on. We're going to put it straight. We're going to give tremendous incentive like no other country has. We're cutting your taxes. We're going to cut them very substantially. We got them down to 21% from probably 42 or 44%, depending on where you are. And we got them down to 21. Everyone said that was a miracle. Now we're getting them down to 15, but only if you make your product here. Otherwise, you pay 21, which is not bad. It's in the middle of the pack, but 15 brings you down to among the lower. And for those that are running the big companies, those great, big, beautiful companies, nobody's going to be leaving us. You're going to be coming back. You're going to be bringing it back to the United States. We are incentivizing everybody to come back to the United States. We want you back here. Car manufacturers, everybody. And we have one product that nobody has really to the extent that we do. It's called oil and gas. There is no country in the world that has more. We're number one. I brought it to number one during my first term in terms of production. We're going to be number one plus. We'll do numbers that nobody will really see before. And when that happens, prices are going to start coming down because people can't afford their groceries, and they're going to be affording their groceries very soon. I tell the story about a woman an old woman, no money, went to a grocery store, had 3 apples. She put them down on the counter, and she looked, and she saw the price, and she said, "Would you excuse me?" And she walked one of the apples back to the refrigerator and came back to pay for the 2 apples. And she left with 2 apples. And the woman at the counter said that was so sad. And when I heard about the story, I said, that should never happen in America. And it's not going to happen in America. We're going to do it right. And we're going to take care of our people. And we're going to do things that nobody ever thought even were possible. But we're going to have an economy the likes of which nobody's ever seen before. And everybody's coming back to America. I saw that the other day at the cathedral. They're all saying, we want to come back. We want to come back. And with a couple of changes done by Howard and Scott and some of the great people up here with me, we're going to bring them all back. They're all coming back. So thank you very much. This is a great honor. And ringing the bell will be fantastic. And go out and get them. We're with you all the way. Thank you very much. Thank you.
And that was President Donald Trump there speaking at the New York Stock Exchange. He was chosen as Times Person of the Year again. He is going to ring the bell to commemorate that at the New York Stock Exchange. I want to bring in Anne-Marie Hordern right now, Bloomberg's chief political correspondent. She is the co-host of Surveillance. I should also say welcome to Bloomberg Open Interest.
Thank you so much for having me.
We've switched feeds here. Great to have you on set. Interesting speech there from President Trump. Obviously not as long as some of his rallies, but he brings up...
Well, he's got the bell to get to. So.
Yes, exactly. He's got to open
He's got to get up the
trading.
stairs.
What do you think was most important? I mean, he talked about the expedited allowance for people who invest more than $1 billion. He talks about weaponry in Ukraine. He talks about cutting taxes, oil and gas. What did you take from that?
What I took from it is what he didn't say. I don't believe he mentioned the word tariffs once. And he has been on a campaign trail talking about how this is the most beautiful word. And that says to me, this is going to be a Donald Trump that, like Donald Trump in 1.0, 2.0 is going to be similar in the way that this is going to be what he's regulated by, the stock exchange and stocks, and whether or not the Dow Jones Industrial Average is red or green on any single day. And the fact is, what you hear from analysts, what you hear from corporate executives, if you read the earnings report, what people are most nervous about is they like all the good stuff that Trump could mean for them. He talked about lowering the tax rate. He talked about deregulation. Come invest in America. We're going to make it easier for you. But he didn't talk about the walls going up. And that has been one of the biggest concerns you hear from individuals on Wall Street. And that's what they would say is the bad things potentially that can happen in Trump 2.0. And in this room downtown, he probably knew that, and he knew who he was talking to, and he didn't mention it once.
It's interesting. There was what he was saying, and then there's who he was with. It was interesting to see who was not only there with him at the stock exchange, but who was right behind him. Scott Bessent, Kelly Loeffler.
Right behind him was not the individuals who are also really leaning into this idea that the wall should go up 60% when it comes to Chinese imports, 10% when it comes to the rest of the world. Look, they were all there, but right directly behind him was his Treasury pick, who we know was applauded when he was picked as the individual. Remember that Game of Thrones went on for days. Who was he going to pick? And he picked someone that Wall Street actually looked kindly on. And that was the man directly behind him. Also notable, his family was there. We haven't seen a ton of Melania Trump, his wife, the First Lady, on the campaign trail, but she was there alongside Ivanka Trump, some other members of his family behind him as he is not just ringing in the bell, which is very Trump trait of him, leaning into this idea, but also the fact that he was named Time Person of the Year today by Time Magazine.
Yeah, really interesting who's who. RFK Jr. was also there. I want to talk about the Time Person of the Year honor, though, because he seemed very warm in his comments towards Time. And, of course, he said that he liked this go-around better than he liked it last time in 2016. You think back to 2020, it was Joe Biden and Kamala Harris who were named. So it's become a bit of a tradition here.
Well, I also think that you do see individuals lining up differently. The rhetoric you're seeing from executives towards Trump this time around than you have in the past. Look at what Meta did overnight. It's a nominal amount for Meta, $1 million, but they're donating to Trump's inaugural committee. They did not do this for Joe Biden, and they didn't do it for Trump 1.0. And this just builds on the fact that you see tech executives and either other executives realizing that they need to make sure that they're in the room or have a direct relationship with President Trump. They've seen what Elon Musk has done. They've seen how helpful it has been to his company, to his personal wealth. Even GM's Mary Barra, speaking in Axios, was saying how there is some similarities and some synergies within the Trump transition team and their campaign that we would like to see. Notable as well, one other thing. He mentioned this in the Time magazine, and he also talked about it there at the NYSE. He talked about Ukraine. And when he was pressed, according to Time magazine, about if he would abandon Ukraine, he did say the only way you're going to reach an agreement is not to abandon. So maybe he comes in on full support of Ukraine to try to get these two individuals to the table.
I want to comment really quickly on what you said about Meta. Over the last week, I was talking to a senior banking executive that said they looked at what the crypto industry had done, and they're looking at that playbook, asking why they're not taking more advantage of Citizens United and pouring more money into races and looking to make a bigger mark on policy moving forward.
Yeah, you got to kiss the ring, right? In terms of Ukraine, I think it's fascinating as well. The fact that he brought up here the importance of the weaponry, right? And he talked in the Time magazine article about the fact that we're sending so many missiles there. He doesn't seem comfortable with it personally, but we know that people, especially from his last administration, like Mike Pompeo, have urged him to blitz the Russians with serious funding, like $600 billion worth. And the Russians already seem at their wits' end, right? They can't hold up their puppet dictatorship in Syria. They're bringing in North Koreans because they're running out of their own soldiers. It does seem like almost a Reagan moment, you know, in terms of pushing them to the brink with funding. Does Trump, do you think, change his tone on that?
It would be to escalate to de-escalate, force this, give Ukraine everything they could. You know, you have to remember, Trump 1.0 was the first administration to send javelins to Ukraine. So you could see him potentially say, I am going to do everything we can to put the pressure on Putin to force him to the negotiating table, because he says he wants to reach that agreement. Now, also, the Biden administration may give him a layup before he comes in. We have reporting this week that they're potentially going to go the harshest they have ever been in terms of sanctioning Russian oil outright, portions of Russian crude exports outright. So not going through a price cap, the same way the United States has sanctions on Iranian crude. And this is how Putin has been able to fund his war. It has been the ability to continue making money off those exports in the fossil fuel industry.
All right, Anne-Marie Hordern, that is our chief political correspondent, also the co-host of Surveillance, breaking down President-elect Donald Trump's remarks ahead of the opening bell, which he will be ringing. Let's check on markets in the meantime, because it's been a busy day already. Of course, we got some economic data at 8:30, jobless claims coming in higher than expected. So, too, did PPI. You take a look at how it's working its way through the markets. Futures down right now. The S&P 500 down about 0.3%, seemingly responding to PPI rather than some picture here of the weakening labor market. And you can see it just gets worse as you go on. Big tech also taking a dive, down about 0.5%. The Russell 2000 down about 0.4%. Much more markets coverage coming up as we count down to those opening bells. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. Opening on a down note, at least we're poised to, because the S&P 500 down about 0.2% after yesterday's rally. Same thing, too, if you take a look at big tech, if you take a look at the small caps. Of course, we're digesting what we saw from the Swiss National Bank, from the ECB. Let's break it all down as we count down to the Fed next week, because joining us now is Invesco Head of Investment Solutions, Alessio de Longis. So a bit of a dovish surprise from the Swiss National Bank. Of course, the ECB cutting rates as expected. Is there any chance that we get some sort of surprise for the Fed next week? Because right now, it's all but baked in that we're going to get a 25 basis point cut.
I think the chances of a dovish surprise are, or any kind of surprise, are very, very limited. The Fed has really committed to the necessity of a gradual but steady rate cutting cycle, and they actually started with a bang, with a 50 basis points initially. So I think no surprises. All central banks are really on a mission to bring rates close to neutral as soon as possible. There is a big debate, of course, where neutral is, but by and large, we expect that trend to continue now in December and for most of 2025, bearing any surprise.
What's your take right now, Alessio, on where neutral is? Are we talking about, 3 and change, or are we talking about 4?
When you look at the estimates of the Federal Reserve through proper academic research, the ranges are quite wide, and we range between 2.4, 3.7%. So that's quite a big range. My own estimate would be closer to the upper end of that range, right? Productivity seems to be increasing, so the real neutral rate is certainly higher today between both productivity and the supply-demand changing dynamics due to demographics. Probably 3.5 it seems about right from my perspective, but obviously there is a large degree of uncertainty around these estimates.
I think a lot of investors have been looking over the last couple of years for any sign of stagflation, and certainly some of the data this morning showed a little bit of a hint of it. How serious of a concern is that?
We're not very concerned about the stagflation risk at this stage. Let's remind ourselves that to begin with, the level of growth is quite high, is not suggesting that stagnant growth. The level of growth is still, especially in the United States, at trend, and that trend rate has been going up recently. With respect to the inflation side of the stagflation argument, we are seeing basically that disinflation trend of the past 18 months has come to a halt. It's stalling, but we are not seeing a reacceleration in inflation per se. So I would say this is closer, if I had to pick, we are still closer to a Goldilocks scenario than a stagflation scenario.
All right, Alessio, stick with us, of course. You're joining us at the opening bell. That is Invesco's head of investment solutions, Alessio de Longis. We do have some breaking news, and this is from the Wall Street Journal, that Starboard Value has taken a stake in Bitcoin mining company Riot. That is a publicly listed Bitcoin miner. You can see shares popping right now, up almost 18.5%. A really interesting move, of course. Bitcoin has been impossible to ignore, and clearly Starboard has taken notice.
Well, part of this, according to the Wall Street Journal, is to make sure that it's pivoting away from just Bitcoin mining into using their capacities, their facilities for hyperscalers. This is something we have seen for other Bitcoin miners trying to move to the AI trade more than just the Bitcoin trade. Certainly both are quite lucrative.
That is absolutely fascinating. I haven't even thought about that. Obviously, Bitcoin miners, their biggest problem was paying for power. So they've moved, years ago to places where power was much more plentiful and much cheaper. And now that could be a huge advantage for AI. Although with Bitcoin at $100,000 a pop, it's pretty profitable itself. Coming up, less than 4 minutes to the opening bell. We're going to start the trading day right after the break with President Donald Trump, President-elect. Looking forward to him ringing the bell and signing the book. This is Bloomberg. All right, we are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at red arrows, slight, but still there. S&P futures down about 0.2%. NASDAQ futures down more than double that, almost 0.5% right now. You hear the opening bell, and you can see President Donald Trump ringing the opening bell down on the New York Stock Exchange to commemorate being chosen as Time Person of the Year again. He's got a cast of characters with him, including J.D. Vance, including Ivanka, including Melania, and I believe Tiffany there at the end. So a big group of people with him, his entire cabinet practically down on the floor of the New York Stock Exchange, watching him, looking up at him as he stands up on that podium. Someone ringing the bell at the NASDAQ market site too. But Donald Trump up there on the podium, he's going to come down, he's going to sign the book, which is more than a century old. If you ring the bell, you get to sign the book. It doesn't go all the way back to the Buttonwood Tree in 1792, but it does have a lot of history. And then he's going to walk around the floor and talk with some of the traders down there. Pete Giacchi, John O'Hara. He's going to talk with Frankie Marciello, Mikey P. It's going to be great, I'm sure, for them, as well as for the president. Katie, what do you see in terms of the major averages right now?
Well, first of all, it's Service Titan over at the NASDAQ. I believe they're an IPO. But in any case, you take a look at the board behind me, and it isn't too pretty. Of course, we saw a rally yesterday shaking off that downward tone that we developed at the start of the week, but clearly resuming declines right now. The S&P 500 down about 0.2%. Big tech was your big winner yesterday. Today, it's the big loser, down about 0.5% on the NASDAQ 100. And then you take a look at the small caps right now, down about 0.3%. Of course, we got hotter than expected PPI. That follows an as expected inflation print, where inflation edged a little bit higher. So a lot of question marks about inflation heading into next week's Fed meeting. But in any case, let's take a look under the hood right now, because Warner Brothers Discovery announced a new corporate structure where the company will serve as the parent of two operating divisions: Global Linear Networks and Streaming and Studios. This frees the company up for strategic flexibility, and CEO David Zaslav has said that the entertainment industry needs more deals, Sonali.
Yeah, you have to wonder if splitting it up in two makes it easy to sell one of those two, but we'll keep an eye on that story as the months go along. Another story that investors like Uber higher after TD Cowen analysts praise the ride-hailing company's direction following an interview with the CFO. Cowen says the UberX arm should see growth of low to mid-teens year on year as driver numbers increase. Uber shares up about 2.6% as the market opens, Matt.
All right, I want to talk about Adobe as well. Those shares dropping. The company, its market cap decimated this morning as a sales forecast that's lower than anticipated comes out. That raises fear that AI startups could eat into the company's business. Adobe continues to see record customer adoption and usage of its AI tools, but that just isn't enough for investors. Let's bring in Bloomberg Technology co-host Caroline Hyde to find out what's going on here. Caroline, thanks so much for joining us here on set. Wow. More than 10% the drop at Adobe. What's the problem?
Worst day since March 2024, when it had a pretty ugly set of numbers back then too. And look, what is a company to do when it's beating on its fiscal fourth quarter results, 11% growth in revenue? They're managing to say that they got record adoption of their AI offerings. But the question is, there's no inflection point here. At what point are we starting to see more than an 11% increase in revenue, which is basically where we've been at for the last year or so? Investors really focusing in on that. Look, they're wanting to see adoption, but that comes at the cost of monetization. And I think the real worry here is this new level of measurement they're using, digital media annual recurring revenue. That came in at about 11% in terms of the forecast. And that's actually slower than the fiscal fourth quarter of 13%. They're forecasting 11%. So once again, it's a question of forecasts not living up to hype. And actually, there hasn't been much hype in this stock for the year anyway.
Yeah, shares down about 17% right now. And obviously, they've been left behind and then some in this AI race. And I find this interesting because Adobe, you think about their suite of products. For a lot of people, especially in creative industries, these are must-have tools. But the AI narrative, to not be a part of it, obviously really painful for Adobe.
And then wanting to see the cadence at which they're letting these new products come out. Look, Firefly has been embedded throughout Photoshop, and you're able to use it within video production, but the real AI generation of video, the equivalent to Sora, that we've seen get into people's hands this week alone at OpenAI, well, they're still not promising it until 2025. So it's like, when are people going to have this transformative technology from a video production perspective? They have really, though, been trying to interlace Firefly throughout the rest of the products. But the question is also, when you start charging more for it, they have hinted that subscriptions are going to get more costly, but that's now being sort of baked in.
They're already impossible to cancel. You know, it took me over a year to cancel an Adobe subscription, like the bane of my existence.
They're getting investigated for that.
I need AI to help me cancel my Adobe subscription.
Sure, there might be one for that.
I mean, speaking of AI stories, this is the cost of not getting ahead in AI, isn't it? And you see throughout the year the people who were doubters for certain strategies. You think about Salesforce really turning the ship around there, and now we're coming to the come to Jesus moment, aren't we? We're like looking at these companies and saying, you either have it or you don't.
And I think they've got a disconnect here. The executives are speaking incredibly optimistically about the adoption of generative AI at their business. The users, the customers love it. It's the investors who haven't quite gotten on board with this narrative yet.
Yeah, disconnect there. Obviously, you can see that in the stock as well. Caroline, great roundup. That, of course, is Bloomberg's Caroline Hyde. And let's get back now with Invesco Head of Investment Solutions, Alessio de Longis. And I'm looking at your note. You write that you have a cautious asset allocation versus your benchmark, that you're overweighting fixed income relative to equities. That caught my eye because that seems like a pretty painful place to be. Bonds have been a basket case, and it feels like the stock market just goes up and to the right, Alessio.
It certainly has been a bit of a painful trade in the last couple of months. We have moved into this cautious stance, though, in the middle of the summer, and the relative performance between equities and fixed income was certainly much more on a bearish tone between July, August. As of today, we find ourselves legitimized more on the call with respect to still positioning towards quality and low volatility equities. We have seen a bit of fatigue with respect to the expected outperformance for cyclicals, such as mid caps and small caps. We continue to see false starts in that outperformance relative to the larger names. The challenge in this macro backdrop, in my opinion, is the following: that the stock market has been led by what traditionally are defensive sectors with quality and low volatility characteristics, right? So especially following the result of the election and some of the excessive optimism, in my opinion, around the outperformance of cyclicals, around the expectations for fiscal expansion and the benefits towards small and mid, we think that the combination of maintaining a cyclical defensive posture in the equity sector and taking advantage of the rise in bond yields in an easing cycle, it's probably prudent as we go into next year.
Hey, Alessio, we're just looking at Donald Trump. I guess he's signed that book down at the New York Stock Exchange. Looks like he's doing an interview with Jim Cramer right now as well. I wonder if those two have a lot to talk about. What do you think you can take from 2016 when we were in the similar situation? You know, his win in 2016, driving up sort of animal spirits, driving up optimism for deregulation and lower taxes. Can you look at that and overlay it with now and make some calls on what's going to happen next year based on what you saw happen following his inauguration last time?
Well, you're bringing up a very interesting analogy, right? If you look at the 1 month following the 2016 election and the 1 month now following this election, the relative performance between asset classes has been incredibly remarkable, identical, nearly identical. Outperformance of small versus large, outperformance of U.S. equities relative to international stocks. In other words, pricing in a positive growth shock in the U.S. and a negative growth shock outside of the U.S. But then what happened in 2016, we saw a perfect reversal, a perfect unwind of those themes. Not because those policies didn't materialize, they actually did materialize, right? Fiscal expansion and antagonizing trade policy and increasing tariffs. But the reality is that those policies were fully priced in the 1 month following the election, and markets focused on other themes that emerged. At the time, it was a surprising acceleration in the global restocking of in the inventory cycle globally that was really led by emerging markets. Should that happen this time around? We don't know. But the point is, let's not overextend ourselves to what seems to be clear trades over the medium term when they are most likely already priced in.
Alessio, thanks so much for joining us. Really appreciate you sticking with us throughout the Trump bell-ringing ceremony there, Alessio de Longis. Coming up, Lazard CEO Peter Orszag says President-elect Donald Trump is right to keep Fed Chair Powell in charge. Not that he has much other choice. We'll talk about that and much more next. This is Bloomberg.
And it's time for today's Wall Street Beat. Lazard CEO Peter Orszag penning an opinion piece in the Washington Post, laying out the case for President-elect Trump to keep Jerome Powell in charge of the Fed. And he writes, quote, the incoming administration should stick to preserving the Federal Reserve's independence, not in fear to Washington norms, but because practical evidence shows that independent central banks produce lower inflation. Peter joins us now. And Peter, you know, when you're thinking about not just what you wrote, this idea that the Fed should just do its job, right? But also about what role the fiscal plays in relation to the monetary. We've been seeing that push-pull already in the Biden administration, frankly. How much will you see it in the Trump administration with the threat of tariffs potentially driving inflation higher?
Well, I think one of the reasons why you've seen the long rate bump back up is because of concern that there are a variety of things that could be inflationary. But I would say the initial appointments, Treasury Secretary, I've known Kevin Hassett for a long time as NEC Director. These are very solid choices. And so there may be some tempering of the campaign promises that have been made in terms of their actual implementation. But directionally, many of the things that are under discussion would push inflation up, and that will make the Fed's job harder.
So over and over, all throughout the course of the week, and even since November, what you really heard from a lot of CEOs is pro-growth, deregulation. But if you think about tariffs or anything else that investors are actually afraid of, what are those things?
Well, first, I mean, on the regulatory front, we've also had appointments which I think do point towards the ending of the biggest bad era, not completely, but at least partially. And the biggest changes you'll see are on vertically integrated deals. That is where the biggest bad crowd under President Biden diverted the most from the traditional Robert Bork type view of antitrust. And therefore, that's where you're going to see the biggest move back. It won't be, completely back to the way antitrust was done in the 1980s and 1990s, but it's clearly a different regulatory environment.
Well, let's talk about what that means for M&A. Obviously, we got the announcement of a new FTC chair. Lena Khan is out despite having the support of J.D. Vance. Andrew Ferguson is in, and it seems like everyone across Wall Street is saying that this is going to lead to this big M&A revival. Would you qualify that at all? What are you expecting in 2025?
Well, I think the most important thing is to realize the M&A cycle was building anyway, and private equity was becoming more active anyway. And so this is an accelerant on top of a cycle that was building anyway. So if you were counting just on this to spur a lot of M&A activity, I think that would have been a mistake. But it's coming on top of something that was already building. And so the first step was the end of interest rate increases, financing markets opening up, bid-ask spreads narrowing. And now we're starting to see, again, sponsors become more active, and then a change in the regulatory environment only adds to. So the environment for M&A looks really constructive as we go into 2025.
I love the Bork callback. I actually have Slouching Towards Gomorrah in the back of my car.
Okay.
I haven't cracked it yet. But
We've been talking about a lot about Icelandic music. It's strange this year.
Let's talk about you. Obviously, were the head of the CBO and the OMB under the Obama administration. So just big picture, right? The hopes of Scott Bessent to bring our budget deficit down to 3% while continuing to grow the economy at a 3% rate. I mean, Doge wanting to cut $2 trillion in spending. What kind of effect would that have on growth?
Well, first, I think we have to evaluate what's likely to happen. For example, there have been decades of attempts going back to, I was in the Clinton administration, reinventing government under Elaine Kmark to find waste, fraud, and abuse. Every administration has a variant of this, and it comes in with a lot of hype, and then you get to reality. It's very hard to make substantial progress on the federal budget unless you're touching entitlements, Medicare, Medicaid, and Social Security, or defense. Interest is spoken for, and if you put all of those to the side, you're left with about 15% or so of the budget. So it's often not as expansive as the rhetoric suggests. But I think at the heart of your question is, yes, if there was a massive move towards a negative fiscal impulse, that is a lot of budget tightening overnight, that would constrain demand and raise some risks about the growth
Even
target.
over 4 years, Peter. I mean, can you really reduce spending by $2 trillion a year over the term of the presidency?
I've got the under on that.
Yeah.
And don't forget, I think the $2 trillion was at least ostensibly supposed to be per year, which is even more unrealistic. But
what about reducing the budget deficit to 3%? Can you get us down to that in year 4 and still have growth?
It is very challenging to get down to 3% of GDP on the deficit unless there is a substantial uptick in growth. So I would kind of reverse it, which is
I got it.
If we have a growth spurt, then the deficit comes down organically. But under current expectations about what the growth path looks like, it's going to be very challenging because we're going to be locking in lower taxes and because I think it's implausible we're going to be doing very much on entitlements.
Well, when you think about the fiscal picture here and that worry about growth, then how much do you have to worry about the potential for stagflation too? You saw a hint of that in this morning's data. Do you really worry about it?
Not particularly. I think fundamentally the economy is still quite strong. Yes, we had a slightly elevated weekly uninsurance claims number, but in general, the economy is performing quite well with the labor market holding up quite well and growth continuing. The U.S. is the envy of the world right now on the macro economy. So I think the big question on the stagflation front is not the stag part, but the inflation part and what happens on inflation. I would think if we don't do many of the things we were just discussing that would put upward pressure on inflation, inflation will continue to come down, but you can obviously do a bunch of things that are going to head it, make that head in the other direction. And that's why, by the way, it's not just saying that you're not going to even try to fire the Federal Reserve chair, but also the rhetoric with regard to Federal Reserve independence. The point of the column this morning was to lay out the evidence on central bank independence for whatever other set of policies you're doing, producing lower inflation because of the credibility of the central bank relative to politicians.
And I do want to go back to the M&A landscape, though, obviously focusing a little bit more on Lazard, because you were saying, we were talking about that more favorable regulatory landscape coming into effect. But I want to marry that together with the economic outlook, because we talked about the risk of higher inflation. There's a risk that interest rates don't come down that much. So how do those two factors work together? The threat of continued higher for longer rates, but also regulation. Which outweighs which?
A couple things. First, before we get to that, the threat of tariffs also does lead to a lot of cross-border activity. So we're seeing a lot of interest from European companies wanting to invest in the United States in order to avoid even the threat of tariffs being imposed and locate themselves inside of the tariff wall. Now, on rates, look, lower rates are better for M&A, but I don't think it's the biggest driver. Often there are many other fundamental things, reach for scale, technological innovation, et cetera, that are tailwinds, and lower rates help, but they're, as long as we don't see a spike in interest rates, I think you're going to see the M&A cycle really continue. And if all we're debating is the rate at which rates decline, what I said earlier about a very constructive environment, especially with a return to a more traditional perspective on antitrust, will hold.
Well, it's interesting because even with this higher level of rates that you've seen, of course, we didn't see as many cuts as the market expected this year. You're still seeing a tremendous amount of capital markets activity. Tremendous. Lazard was an advisor this week, really, on a $2 billion loan that Blackstone provided to Dropbox.
Yes.
You're expanding well beyond M&A into these capital markets activities. What does this mean at the end of the day? Does this mean that kind of the markets are wide open and debt markets are flush with money and people will keep borrowing at rates like this, and there's no worry about this kind of higher for longer environment?
Well, what I'd say is obviously financing markets are reopened, and that transaction that you mentioned is particularly interesting. We have something called Lazard Capital Solutions. It operates at the intersection of public and private credit and other financing markets. And that is what's really interesting is you're seeing more competition now. We've obviously experienced a massive growth in private credit. Public debt markets are also becoming, are reopened. And so helping our clients navigate the trade-offs and creating some competitive tension between those alternative sources of financing is a really promising vector for us.
Blackstone competing with the banks, we are here for it. Peter Orszag, we thank you so very much for your time. That is Peter Orszag, of course, the CEO of Lazard. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Hershey is getting cut to a sell at Wells Fargo. The firm is also cutting its price target, saying that the chocolate company is on the precipice of historic earnings pressure into 2025 and into next year from higher cocoa prices. The analyst says that earnings estimates need to come down substantially. A lot of M&A speculation about this stock as well. Next up, Morgan Stanley is upgrading Equifax to a buy, saying that the Consumer Credit Reporting Agency has an attractive valuation and favorable regulatory environment heading into next year. Shares up about 1.7%. And finally, this is a fun one. JP Morgan initiating coverage of Celsius Holdings with a buy rating. The firm cites the energy drink maker's attractive valuation, also says that the brand has broadened its appeal outside of the typical energy drink consumers to attract more affluent females, rich ladies, I guess, Matt.
Yeah, well, I don't know. it doesn't seem very healthy.
Outside of gaming, bros, I don't know.
I'm not a doctor, but
No?
I don't think I would, if I were, that I would recommend someone drink it a lot.
Yeah, it's probably not good for
Sonali
your
drinks a
blood
little too much.
pressure.
I probably drink it every day. Actually, what time is it? It's like 10 a.m. and I have a similar thing on set.
Yeah, just water would be good, you know?
It's better than coffee.
Is it?
I mean, it doesn't make you as jittery. It doesn't dehydrate you. How about that?
Maybe I'll give it a shot. Coming up in the next hour, we'll see what David Kostin drinks. We'll also ask him to share the stocks that he likes, the stocks with the highest perspective of risk-adjusted returns, and then we'll talk to the CEO of Tradeweb. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, a rally in stocks takes a breather after a mixed bag of economic data. We're going to speak with Wall Street bull David Kostin of Goldman Sachs.
Speaking of bull markets, we are putting the spotlight on classic cars today as an alternative investment with McKeel Hagerty. He's the CEO of the world's largest provider of classic car insurance.
Plus, a significant shift underway in electronic trading. Tradeweb CEO Billy Hult tells us what's reshaping the global trading landscape. All of that and more coming up. But let's take a check on these markets right now because you're looking at a down day on Wall Street. The S&P 500 down by about 0.2%. Big tech is your loss leader. The Nasdaq 100 down about 0.5%, seemingly responding to that hotter than expected PPI print. And then you take a look at the bond market too. This is interesting. Yields going a little bit higher right now, maybe also in response. We did get initial jobless claims that were higher than expected. Maybe some weakness appearing in the labor market, but it seems like inflation is on everyone's mind right now, Matt.
Yeah, absolutely. And the Fed, less than 1 week until we get that decision. So a lot of people putting in their bets right now. Let's talk to David Kostin from Goldman Sachs. He's the chief of U.S. equity strategy there, and or the chief U.S. equity strategist, I should say, David. And it's great to get you on to talk about your expectations with the market. And I'd love to just get your take on the Fed. You know, how important is the Fed cutting cycle right now, as I think everyone has reduced his or her expectations for the terminal rate. What are you looking at?
Well, I have the benefit of working with the Goldman Sachs economics team, and their forecast right now is the Fed will cut next week as well as the beginning of next year. That's mostly priced into the market. The expectation for most portfolio managers with whom I interact on a regular basis are expecting an easing cycle to continue, and the stock market is pricing as though the underlying economic growth is closer to 5%. The economy, of course, is not growing as rapidly as that, but the performance of cyclical stocks relative to defensive stocks is more consistent with a pretty robust economic underlying activity. In fact, that is what most of the fund managers are anticipating. The animal spirits have really been out in force in the last month. We've seen the market rally by roughly 5% since the election. You saw recently the NFIB Small Business Optimism Index jump sharply. That's pretty consistent with what we saw in the first Trump administration. The expectation of more business-friendly environment, whether that's true or not, of course, that remains to be seen. CEO confidence is typically highest in a unified Republican government. So that also is, I think, one of the reasons why you've seen and we are expecting a 25% increase in M&A activity next year. The CEO confidence is one of the key variables, along with financial conditions and economic activity. So those are some of the attributes around why business expectations are pretty strong. The stock market is pricing that, and we have expectations of roughly 7% increase in the S&P 500 during the next 12 months to around 6,500. So that's sort of the lay of the land, Matt, as we see it now.
David, what do you tell people who are following the animal spirits? Should they keep following the animal spirits, or is there something more under the hood they should be looking at, given that when we look at your analysis, you're taking a look at a very, very specific set of stocks that should outperform and not just the entire index?
So we have a couple of strategies that we think about in this environment. One would be companies whose customer base or customer clients are small and mid-sized businesses. The intuition behind that is that companies that are small businesses are looking to spend more money in the idea of a more optimistic outlook. So if you're a supplier of those to those businesses, that's usually a good source of potential positive earnings revisions, more greater business. A group of stocks that my colleague, economic or stock analysts at Goldman, have identified as a greater than average probability of being acquired in a merger. That's a strategy. We published the other day, last week, looking at companies with a high risk-adjusted return. The idea of the expected risk-adjusted return being quite high in the coming year would be an appropriate strategy in our view, because the stock market trades at a very high valuation level. And there's a slight value bias or value tilt to a group of stocks with the highest potential risk-adjusted returns. And I think that's an important strategy to think about, given the uncertainty, Sonali, around the tariffs, exactly what will happen with inflation, employment situation. So there's certain undercurrents of concern. And so the idea of choosing stocks with high risk-adjusted return, I think, is an appropriate way to set up a portfolio at this time. We think of it as terms of various slices of strategies.
I want to go back to the strategy you mentioned about stocks with a higher M&A potential. Obviously, we've been talking about the antitrust, the regulatory environment that's expected in 2025, especially with a new FTC chair named. Clearly, there's a lot of interest among Wall Street firms in that. What are your conversations with clients around that sound? Have you also seen an increase in interest from investors to pursue that type of strategy?
We have. In fact, the Goldman Sachs Financial Services Conference was held on Tuesday and Wednesday of this week. And there was quite a lot of the CEOs who were talking about the expectation they had for increased M&A activity in calendar 2025. Investors, as a consequence, are also quite focused in this area. And we have a group of stocks where, typically, if you look at the S&P 1,500, 1,500, there's about a 2% of those companies get acquired each year. And the group of stocks to which I referred earlier, which my colleague analysts have identified as a greater than average probability, we have about a 9% hit rate of acquisitions. Those stocks tend to outperform, as you would anticipate. Usually a merger comes at a premium. That's been a driving force behind why we get lots of inquiries looking at this list of 62 companies.
How do you look out, David, for black swans? I mean, we're in a situation where we really haven't had any for so long. The market's up almost 30% this year, the S&P at least. It was up 25% last year, and it's had an incredible run since the bottom in 2009, from 666 to over 6,000. What do you do to try and factor that into your models, the potential of an unknown unknown?
Well, since you referenced Donald Rumsfeld's famous dictum, known knowns and known unknowns and unknown unknowns, it's a question. Kind of hard to forecast a black swan. Well, one way, Matt, to combat that or to tackle that problem would be to look at companies with a high risk-adjusted return, because that's factored in to a certain degree, not a specific black swan event, but rather the idea of overall risk, the idea of a potentially high return adjusted for that risk. And that's a goal. That's the holy grail of all portfolio managers, to get the best risk-adjusted return that he or she can. So how do we think about it? Well, we look at some of the big macro issues that are there and try to understand valuation. The setup with the stock market trading at such high PE multiple does create asymmetries in terms of downside risk if there's real disappointments on the underlying fundamentals. So value has a potential component in a portfolio. I think the way to think about it is a portfolio in a true portfolio sense, with multiple strategies in place. Some that are maybe companies that are likely to have an M&A activity, some that are forecast to have more customer base in the small area that we talked about, or risk-adjusted returns. Those combinations, I think, is a right way to approach a market that trades at a very high valuation, historically speaking. And that's, I think, that's how we would advocate and recommend to our clients.
David, we thank you so very much for joining us. Of course, that is David Kostin of Goldman Sachs. We thank you for your time. And tomorrow we'll be speaking with Morgan Stanley's chief U.S. equity strategist, Mike Wilson. That's at 9 a.m. New York time. And coming up, Billy Hult, CEO of Tradeweb, joins us at the desk to talk about the future of electronic trading. Stick with us for that conversation. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. President-elect Donald Trump rang the opening bell at the New York Stock Exchange last hour to a cheering crowd of traders and business leaders. Trump was named Time Magazine's Person of the Year. The magazine bestowed the title on Trump for his stunning political comeback in the election. He was joined at the podium by many of his most prominent cabinet nominees, they were mostly under the podium, actually. Scott Bessent, Howard Lutnick, and Robert F. Kennedy Jr., among others. They're all standing like right down here. That's mostly his family. CBS is reporting that President-elect Donald Trump is inviting Chinese President Xi Jinping to his inauguration next month. Xi's attendance, however, appears unlikely, as no Chinese leader has ever attended an inauguration ceremony of a U.S. president. In fact, no foreign head of state has attended one in more than a century, so we'll be waiting to see what these two do. And basketball legend Michael Jordan has finally sold his Chicago mansion for $9.5 million. That's 1/3 of the initial listing price on Zillow. It was $29 million. Jordan initially advertised the 7-acre, 19-bedroom estate adorned with the number 23 on the front gate way back in 2012, and he finally makes the sale over a decade later. Katie?
All right, let's get back to Wall Street, because 2024 has set the stage for very significant change in electronic trading. That's the message from electronic marketplace Tradeweb. In the company's annual letter, CEO Billy Hult writes, from AI and digital assets to evolving market structure and liquidity providers, these changes are building a foundation for a future where technology will continue to fundamentally reshape financial markets. I'm pleased to say that Tradeweb Market CEO Billy Hult joins us right now on set. Great to see you in person.
Thanks so much for having me.
So let's start with your letter. Of course, it feels like every industry is undergoing very significant change right now, but what changes do you see underway in the electronic trading landscape?
Thanks for having me. I feel like I graduated. I used to call into you guys, then I was on a video, and now
you're at the big boy desk.
Coffee talk.
Welcome.
Coffee talk with Tradeweb.
Yeah.
Thank you guys very much. It's like from liar's poker, steak sandwiches at 9 in the morning to the modern age in fixed income and in the bond markets. It's incredible the amount of investments that have taken place in terms of moving these markets into a more efficient place. AIX trading, I describe it as algorithms that connect to liquidity in the market, is a big driving force around efficiency. And then you have the emergence of these alternative market makers, the Citadels, the Jane Streets of the world, that are applying technology to become real presences in my space. It's an incredibly exciting time to be in the markets business and to be on the technology side of the markets business.
Billy, do you think that the banks realize just the competitive threat that they're facing from the likes of a Jane Street and a Citadel Securities? Because Jane Street is already, in 9 months of the year, the first 9 months, they have surpassed their record haul from a year ago, and they're all expanding into new businesses.
I think absolutely they do. You know, and particularly the smartest and best run firms do, because there's a big difference between sort of being in the first tier 5 years ago and having other banks behind you, and then having the types of firms like Citadel and Jane coming up the ranks the way they do. The machine learning that these firms are able to do, applying the expertise that they have traditionally in anonymous markets, equities, et cetera, and then learning those rules and learning how to apply that into fixed income is a formidable combination. And I think the buy side, the investor base, wants more counterparties. There's been a pretty decent amount of consolidation at the top around market making, and I think there's an appetite for more liquidity by different participants. This is a pretty nice convergence of a setting for these types of firms. So the best run firms see this coming.
In terms of the bond market specifically, you mentioned Liar's Poker, and what a fantastic book. I'd like to get back to those times.
He's a good writer.
He's great.
Yeah.
But I mean, I also love the romance of those days on Wall Street. It's gone, obviously.
Romance?
Yeah. I mean, anyway, in terms of what we saw back then, things like bond vigilantes, right? Yeah. Actually making a difference in the policy of the United States of America. Can that happen again?
Good question. Lesser kind of effective at all these days. I agree with you. As the markets have gotten sort of more connected, it's harder to have that kind of bond vigilante kind of effect in the world. That being said, my instinct is the smartest, most talented people still come up through those kind of fixed income derivatives ranks on the street.
They're not on the tech side? Because I feel like all the guys I know who are bond traders are retired now, right?
There are still some very large personalities who grew up in the ranks through those liar poker days that run these businesses that are the best and the brightest. That being said, is the skill set more technical? Are there less, pizzas arriving at 10 a.m. than there were back when I grew up in the business? Like, of course, it's a more technical kind of marketplace. That being said, I think, the one of the things that we'll talk about, I'm sure, is that what's happening around, deregulation. I think the strength of these global businesses is going to be very, very strong in the next few years. I think the outlook for the trading businesses is going to be quite good.
Well, one of the ways that trading has changed in the fixed income market specifically, according to Bloomberg Intelligence, electronic trading is now 55% of volumes. At least that's what our numbers show. I mean, I would love to hear your perspective on that, as to how much it can actually account for versus, people just still calling each other up on the phone.
The markets are all going to move to a completely digitized state. That being said, is somebody picking up the phone right now and doing a trade like it's 1994? Yes. Larger risk-moving trades, more complicated negotiated trades still happen on the phone. We're applying a lot of resource and energy and technology to kind of solve for that. Will it ever go to 100%?
Yeah, will it?
It's going to stay relationship-based. So I think there's ways to electronify flow and understand that relationships in the space still really matter a lot, which for me actually makes things more fun.
So what does this mean for Wall Street jobs also? Because we had Cliff Asness here a number of weeks ago. He was saying that he has AI doing parts of his own job. Yeah. And there's that famous story over at Goldman where a trading desk of equities of 500 people went to 3 people with the use of electronification. The fixed income markets is like the next frontier of this evolution. There has to be shrinkage, no?
A little bit, I think. Look, the banks are still going to do, more with less. That being said, my instinct is salespeople matter, relationships matter. The best traders will still kind of thrive at the end of the day. And I think it's a great time to be in the business. I mean, it's a great time to be a trader or a salesperson and work for one of these firms. Change is good. And my instinct is, the best firms are embracing that change in a really good way.
You mentioned the potential change of deregulation. Yeah. I think a lot are looking forward to that. It's so crazy to me that in this world, you can't send your contacts like a WhatsApp if you're working at the bank. Why not?
Yeah.
It's a new SEC chair. Who knows?
Well, yeah, exactly. So what do you expect from deregulation? How will that change the business?
There was a thought process around Basel III that was not a great outcome for the banks, that they were going to have challenges around their balance sheet. I think as that kind of maybe gets pushed back, I come back to the point around the sort of formidability of the big American banks and then this entrance of these newcomers, the Janes and the Citadels, and really the ability to kind of thrive in the space in a big way. So I think there's an incredible amounts of enthusiasm that's taking place at the banks and on the trading floors.
I want to talk about some of these animal spirits around antitrust, deregulation as it relates to your business, because I was taking a look at your share price. You hit a record high in November. The stock is up 46% on a total return basis year to date. Would you ever consider some acquisitions here?
We've done 3 deals in about 2 years, smaller deals. We have great energy and momentum in our organic businesses, like migrating this voice business, this 1994 business, to electronics. That being said, we're open to bigger opportunities, and I think the landscape going forward will play to our strengths.
Well, Billy, keep in touch, especially on that last point.
Invite me back, please.
Definitely.
Thank you for having me, guys.
Yeah,
please.
On set, at the desk. It's great to see you.
Great to see you all. Thank you for having me.
That is Billy Hult. He is the CEO of Tradeweb Markets. And Bloomberg LP, the parent company of Bloomberg News, competes with Thomson Reuters and Refinitiv in providing news, data, and information to the financial industry. Refinitiv holds a majority of the combined voting power in Tradeweb. Now, still ahead, new parents who work at Netflix are not chilling these days. We'll have the details next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, a cybersecurity attack is hampering some folks from getting their donuts online at Krispy Kreme. The company is investigating the hack and working with external cybersecurity experts to mitigate the impact. Those craving a Krispy Kreme donut can still visit stores in person for their sugar fix. Next up, Walmart is pouring more firepower into its fledgling financial venture, scoring a $2.5 billion valuation for the startup. The news signals Walmart's ambition to wade deeper into financial services, and the endeavor, called One, offers products like installment loans, debit cards, and payment services. And finally, changes are reportedly afoot at Netflix, and some new parents aren't happy. 10 years ago, the streaming media giant unveiled a generous parental leave policy that would give new parents unlimited time off in their child's first year of life. However, the Wall Street Journal is reporting that the company has spent the past few years walking back the policy with vague and conflicting guidance, and today, taking more than 6 months of leave is now widely understood to be an unwise career move, Matt Miller, according at least to that article.
You know what? I have never understood. Generally, when you hear about these fun startups that have ping pong tables and unlimited vacation time, you know, just aside from the parental leave, how does that work? Unlimited vacation. That's never made any sense to me.
You don't actually take it. You know, it ends up being this thing where everyone feels bad about taking time off versus you have vacation days that you actually need to spend.
You wouldn't take it, would you?
No. I would not leave this building.
No.
Most people here are not taking it. But, you know, it's no longer a startup, Matt. I would just point out.
There's obviously, you know, there's
very far from
thousands and thousands of people working there. I will say, you know, I had 6 months of paternity leave, and it was like the greatest thing that's ever happened to me. So I recommend it.
There you go. Anyway, coming up, collector cars that can make you a mint. Hagerty is out with the hottest rise on the rise. We'll speak with McKeel Hagerty, Hagerty Insurance CEO, next. This is Bloomberg.
Hagerty Insurance has become a media, events, and auctions powerhouse after a string of acquisitions in recent years. And the classic car conglomerate has become known for its bull market list of value vehicles collectors and investors should consider picking up now before prices climb higher. Here to share some of the cars on the list, as well as insight into the growing business, is the CEO, McKeel Hagerty. McKeel, great to have you on the program. I want to ask, before we get into the cars, and I have a lot of questions on the cars, about the cost. The rising cost of car insurance has been an issue for the CPI until the last couple of readings. Is it done now? What drove it? What's the trajectory look like to you? What can you tell us about it?
It's a big question, right? And it's one that affects consumers, and nobody loves it when costs rise like that. But the insurance industry faced literally a kind of perfect storm, COVID, which stacked up a couple of years of claims. You had a lot of catastrophic events like wildfires and hurricanes, and then just rising costs everywhere really drove prices up. Double digits in most states for property and auto insurance. For us in the classic car space, we were a little less affected. We're not immune from it. We saw more like single-digit increases in prices, but we think it's leveled off. I don't think you're going to see those prices go down anytime soon, but I think the leveling off is good news for consumers.
There was an amazing run-up in prices for all cars, new, used, but also classic cars during COVID. Obviously, we saw auction prices shoot higher. As you were building, you know, I love listening to Hagerty podcasts. I watch Hagerty videos on YouTube. If I want to buy a car, I'll go to a Hagerty auction. But this year has been a down market for prices, especially in the collector's market. How is that affecting your business?
Well, it definitely peaked at the top end of the market in late 2022, December, actually, the data shows. And so we've been kind of flat to down a little bit for the last 2 years. 2024, we saw auction results down about 12%, online down about 5%. But again, we're saying down against what is generally pretty strong demand. And I think the thing that surprises us the most, and it's one of the reasons why we publish some of these lists about cars that are up and coming, is indeed the next generations, the rising collecting generations are into cars, and they're liking to buy cars, but they need affordable entry points. And everybody loves talking about $1 million cars. I do too. But the these new entry points for the next generation are pretty fascinating to see in the data.
Well, in addition to the prices that we're talking about, the average age of the cars in the bull market list, which you put out a couple days ago, has also been getting down. And Matt made the point to us earlier that actually half of the list is now from this century, which is pretty amazing. I mean, what do you think is behind that dynamic?
Well, again, I think a little bit of it is entry points, and everybody though would love to have the big Mona Lisa, amazing $1 million cars from the 50s and 60s, but they can't afford them. That's not where collectors start. They start with something that they can see, something that they can get their hands on. And what we see in the data around this particular list of vehicles is some pretty cool trends. You're right, like 90s and 2000s era cars are really on the rise. Kind of vintage, I have a hard time calling them SUVs, call it vintage off-road vehicles, are really been in great demand for the last few years and really evident in this list. And then you see some surprises, like a Mini or certainly the DeLorean, which is, kind of that great reflection of pop culture from Back to the Future.
What's up with that? I mean, the DeLorean, the kids in the control room, we're so excited about that. Obviously, everyone knows it from the movie, but isn't it a dog? I mean, this came out with a Volvo V6, and I think 130 horsepower for a big stainless steel vehicle is going to have a tough time getting up to 88 miles an hour.
Oh, yeah, I think that would be aspirational for the car in certain conditions. Yeah, they weren't fast, but they looked pretty cool. And I think, they were so maligned by so many people in the way that the company failed that, they just were underappreciated. And now there are restorers that specialize in these. There are clubs that specialize in them. They have a real cult following, just like some of the other cars on this list. It's fascinating. And so, again, I always think entry points. What is the next generation interested in? And every one of these has a following somewhere, and we see the value starting to rise. But I think the opportunity for people is to say, if you want to get into cars, these are the places to look, before the values go up too fast.
Ultimately, you think about the way that the automakers are piling into electric, you're talking about the next generation. Is the next generation really that interested in EVs? And do they have significant price appreciation attached to it?
Well, EVs are, I think, here to stay, and certainly they're going to be an important part of the automotive future. I don't view this like a big religious war like some people do, like the difference between EVs and internal combustion. To me, it's another way that cars will be propelled in the future. And quite honestly, I'm an EV owner, and the cars are fun, they're fast. But I also like internal combustion engine cars. We do not yet see the appreciation in most of these cars, other than the early Tesla Roadsters. I think more is to come there as the industry settles into what EVs are going to be for us and what they're going to look like. In our world, though, I would always say that you're going to be looking for the performance variants, the higher performance variants, or the best looking ones. And that's where you see some cars emerging. Like I think, I'm a personal fan of the Porsche Taycan, for example. I think that's a really great example of a good-looking EV.
I want to get back, though, to real cars that have gasoline motors. The Jaguar E-Type has been, Enzo Ferrari said it was the most beautiful car ever made, reportedly. I'm not sure if he actually said that, but that is attributed to Enzo Ferrari. And I can't believe that you can still get these for an affordable price. Why is this on your list?
Well, again, we're finding these emerging trends when some of those cars from the 50s and 60s were actually a little soft for the last few years. What we've seen is that this next generation of collectors, the millennials, the Gen Xers, are looking for kind of affordable examples of elegant cars with style and flair and taste, that allows you to get all of that attention maybe at the coffee shop on a Saturday or Sunday morning. And we just saw this emerging trend of more interest in Jaguar E-Types, especially the earlier ones. And they are just gorgeous. I agree, though. I'm not sure whether Enzo Ferrari actually said it, but it's a great myth behind the Jaguar E-Type.
I don't know if the Dodge Magnum SRT8 is elegant. I'm a fan. I actually bought a Challenger from the last call generation of 2023. Are some of these, big inch Detroit muscle cars clearly done being made going to be worth money someday, or did they make so many of them that it's like a Mustang where they're always going to be, you know, $25,000?
Well, there's always a culling process, right? You know, they're just like the original muscle cars back in the late 1960s, early 1970s. Some of them went away forever. They were destroyed or they just kind of fell apart. But the best of them tended to remain or they got restored. And then the values eventually started creeping up. What I've been telling people for a long time is that we've been in this second golden age of muscle cars with cars like you described, the Challengers and the Challengers, Chargers, all of those types of cars. These are cars with a lot of power, that big muscle car feel, muscle car look, but they're actually more efficient than the original muscle car generations were. And I think the best of them will appreciate in value, and they certainly are popular. You know, there's no doubt about it that they served up some great fresh muscle cars for the new generation to be interested in.
All right, McKeel, great having you on the program, and I'm looking forward to having you on my podcast as well. McKeel Hagerty, the CEO of Hagerty Insurance. We're going to talk to him. Hannah, Elliott, and I will talk to him on Hot Pursuit, that's my podcast, about a number of these cars, but also about the Ferrari 250 California Spider that they're going to sell at Amelia Island. It is a lot like the one that Cameron's dad drove in, that Cameron and Ferris drove in Ferris Bueller's Day Off.
Actually, have seen that one.
And it will be the most expensive car that they have sold at an auction. So it should be fascinating. I think that picture is from Le Mans in 1959.
Looks old.
Yeah. Definitely tune into my podcast, though. Did I mention that I have a podcast?
You certainly
have I said that before?
It's good that we're showing the
podcast.
graphic,
Katie has a
too.
newsletter. But, you know, I am going to listen to it. We all have a show. I know, and we bring all those interests together here. I'm excited to listen to your podcast this weekend.
Thank you so much.
I'm trying to learn about cars.
Thank you so much. I think everyone should. We're going to talk more about business, real estate with this guy. I recognize him. Igal Namdar is on Wall Street Week. David Weston is going to join us to talk about this interview next. This is Bloomberg. This is Open Interest. You're looking live at the principal room. Coming up on Bloomberg Technology, an interview with the CEO of Klarna. That's 11:30 New York time. This is Bloomberg.
Time now for our daily Wall Street Week conversation. And 40 years ago, there were approximately 2,500 malls in the U.S. Today, there are fewer than 1,000. David Weston spoke with Namdar Realty Group CEO Igal Namdar about what specific malls are a good investment.
We don't think they're dying. I think they're the ones that are left. I mean, I think it was 1,100 enclosed malls, and now it's maybe down to 700 to 800 in that range. So the better malls have a place in the market, and we think what's left, we don't think they're all going to die. However, there are some that will probably die in the future.
When you look for an investment in a mall, what's the profile you look for?
Well, look for a great location, a good market, strong market, a growing market. We look at the mix of tenants in the mall, occupancy, who the anchors are, sales of tenants, the trend, what's been, let's say, in the last 5 years. It's a trend going up. Is it flat? Is it going down? The health ratio of the tenants. These usually indicate to us whether you have a long life with cash flow, that you could project that longer life out of these malls, and hopefully, for a good period of time.
Are the best investments in malls the top-end malls that are doing really well, or are they the ones that are struggling? Because often the valuations can be more attractive for those.
So I think it's neither one. I would say the top malls, the A malls, where the Simons of the world and Maastricht own those malls. I would say they don't trade hands as much, and they tend to be trading at a single-digit cap rate. Then there are malls that are dying. We call them the C malls. Those aren't as attractive as well. What we like to invest in is the B or B plus malls. Those are malls that they do well, but they're one level below the A. And there we feel that there's a arbitrage in the cap rates, that you could buy them at much more attractive cap rates than the A, and maybe a little bit less than the C's that we feel don't have much life left in them.
One of the things we hear a lot about is department stores and some of the challenges we have with department stores. Often those were the flagship tenants, some of these malls. What is going on with those flagship tenants? Do you need them?
Well, of course, you need them mainly for co-tenancy purposes, because most of these leases are written in a way that if certain anchors are not there, then tenants have the right to break their lease or pay reduced rent for that reason. But we've seen in some of the malls that we have that anchors have been out for 5 or 7 years or 10 years, the tenants still do well. So we don't think, as in regards to the tenants' their actual volume makes as much of a difference, but gives them the right to renegotiate their lease, reduce their rent, and potentially leave the market. So for that reason, I think it's still important to have these anchors in the malls.
That was Igal Namdar speaking to David Weston, who joins us now. David, really interesting conversation, both just the decline in the number of American malls, but also his preference for those sort of mid-tier B plus malls and the opportunity he sees there.
It's that cap spread that I had to learn about, capitalization spread, the difference between what you have to pay for the mall and what it can return. And on the really A and A plus malls, there's not much of a margin there at all. Also, they don't turn over very much. And the C's, as he said, a lot of the C's are dying, but the B's are places where there may be attractive investments if they pick their spots. And they pick location. The important thing about location is not whether it's a nice place. The important question is, what's the income of the people in concentric circles reaching out from the mall? That's how they decide.
Well, how do you kind of handicap his relationship to the regions that he is operating in?
Really important, because it's not just the stores that need to make money, and it's not just the owner of the mall that needs to make money. That's a tax base for that community. And as some of those malls have gone away or have struggled or the revenues have gone down, the tax bases are, and we talked actually to the borough manager of a borough out in Pennsylvania, where actually Igal Namdar has a mall, and she was very concerned. They've lost a lot of money in their tax base. base. And she would like him to invest and really develop. On the other hand, he said, look, we'd love to do that, but we can't get the clearance from her government to be able to do that. There's sort of a disagreement about where the problem lies.
So I'm starting to think Wall Street Week is going to focus in on real estate this week.
Well, we're going to have a fair amount of real estate.
What's the show about this week?
Well, we've got a range of things we're doing, actually. We actually have a story as well about insurance and what the problems are of insurance. And we're covering several different topics. But we focused on real estate in part because of the question that Igal was addressing, which is a lot of people think malls are just going to die. And the consensus was they're not going to die. They're going to spin around. But as you know, because of the interest rate increase, it really took the valuation of a lot of that commercial real estate down.
Yeah, to the pandemic. Also, you think about e-commerce, and people just got used to shopping online. I'm sure that, of course, will be a topic of conversation. Really looking forward to Wall Street Week this week. That is David Weston, and you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, Bloomberg's flagship ETF event kicks off in New York today, focusing on the growth and the opportunities in the industry. I'll be sitting down with Tom Lee of Fundstrat to talk about his ETF launch. We'll also hear from Katie Steiner from Citadel, Julie Abbott from JP Morgan, also Anna Paglia from State Street Global Advisors. Let's talk about it all with James Seyfert right now. He is an ETF analyst over at Bloomberg Intelligence. He has a busy afternoon coming up, and you guys do this every year. What's going to be some of the hottest topics that are talked about today?
Yeah, so the first year we did this was 2015. We missed a year or two there due to COVID, but
there was a pandemic or
something messed things up, so we couldn't really do in-person events. But I mean, there's a whole bunch of different topics, right? I'm doing a panel with your two guests you're talking about later, Julie and Katie, and we're going to be covering fixed income, how fixed income ETFs have changed the structure of fixed income trading. We're going to do a debate between gold versus crypto with some gold bugs and crypto bugs from Grayscale. As you said, we're starting off with Tom Lee, a famous bull on Wall Street, and we're going to end it with Nouriel Roubini, who is a famous bear on Wall Street. So we're bookending with two opposite ends of the spectrum.
Tom Lee was actually in my motorcycle gang.
No kidding.
I put together a motorcycle gang of
you guys caused ruckus.
Me, Tom, Binky Chada.
It's fun.
Tobias Levkovich. It was a great group. Anyway, one thing that I wonder about ETFs is as they get bigger and bigger, and we saw $1 trillion of inflows just in the U.S. this year, and we're expecting globally, 15 trillion in ETFs.
I mean, we're already there.
We're there?
Yeah.
Okay, so it's huge, but you still can't, as a normal sort of teachers and cops, like in your retirement account, mess around with ETFs. How long is it going to take before we get there?
Yeah, I mean, we're getting there already. There are platforms where your retirement accounts can invest in ETFs. In many cases, there are strategies that are in the type of mutual fund structures you're talking about, and they just duplicate the strategies in ETFs. We think next year is going to be the year that we see ETF share classes bolted on to the end of mutual funds.
Next year?
Possibly next year. I'm not going to guarantee
that's bold. That's bold.
I would say by the end of 2026, I'd bet on Paul Atkins coming in, assuming he gets in at the SEC. He tends to be more libertarian-minded. I think it just makes sense. That's where things are going. Canada already has it. A lot of places around the world allow you to bolt on an ETF share class. It basically, but the other thing I would say is those people, they don't get all the same benefits from the ETF wrapper. The real benefits, there's many, right? They're liquid, you can trade them. One of the main benefits is the tax efficiency.
Yeah.
Those pension funds you're talking about, they're in a wrapper where the tax efficiency doesn't matter because they're in tax advantage accounts. So they basically lose some of their superpowers, ETFs do, when you put them in a tax advantage account.
But for me, it's the cost, right? The fact that an ETF running the same strategy as a mutual fund charges, I don't know, 60 basis points less blows my mind. How is that?
They're converging. They're coming down. That's what we're seeing. They're converging. Even mutual funds are lowering.
Go back to something Katie was talking about a little earlier. You have Tom Lee, you have Nouriel Roubini, all at this program. So when you look at these kind of single name investors attach their name to an ETF, curious from both of you. I mean, how attractive is this to investors?
Well, it's interesting. It just feels like where the money is going, and these big name investors are following the money. I think the fact that we have Tom Lee and Nouriel Roubini, like you say, bookending, bull and bear, but also two big names who have come into the ETF wrapper.
Yeah, and I'd also say Scott Besson has a filing for an ETF who's now going to be treasury secretary. It was supposed to launch. I don't know what's going to happen there. So maybe that's not going to happen. But I mean, what it comes down to is they're not launching hedge funds anymore. Like she said, this is where the money is going. We started the year about 11 trillion in ETFs. We're at 15 trillion. I mean, this is really fast growing stuff. This is where the money is pouring in. And if you're going to launch a product, this is probably where you want to launch it.
It's also becoming more active, too. I mean, we talk about Tom Lee launching an ETF. That is the FundStrat Granny Shots U.S. Large Cap ETF. It only has 37 holdings. I mean, you have a lot of active flavor funds that are systematic and rules-based, but this is pure stock picking here.
Yeah, this goes to another trend that we're seeing is like a lot of the, closet indexing where you're holding all the same stocks and just different weight and you kind of get a lot of the same types of exposure. People don't want that anymore in their ETF. They want it, there's cheap beta they can get out there for 3 basis points in some cases. They like what she's talking about, these concentrated alpha type portfolios. They'll buy the cheap beta and then they'll go after somebody else who's going to go real after concentration and alpha and try to outperform the index.
Nancy Pelosi should launch an ETF.
Well,
She generates so much alpha somehow.
That's true. Maybe she should retire first. In any case, James, we're spending all afternoon together, so I'll say goodbye to you now. That is James Seyfert of Bloomberg Intelligence. And you can follow along with Bloomberg's ETFs in-depth event by typing LiveGo on your terminal, kicking off a little later this afternoon. Tune in to ETF IQ every Monday at 12 p.m. Eastern. We're not done with the promos because you can also read all about the ETF industry in my weekly newsletter.
Wow.
Bloomberg.com/newsletters and then search for it. Was that good? Anything else we should promote?
You have a podcast as well.
I do. Yeah. It's not necessarily related to ETFs, but we talk about ETFs a lot. Money Stuff with Matt Levine. That comes out on Fridays. In any case, what are markets doing? It's been a while since we looked at them.
Good point. Yeah, let's take a look at markets and what they're doing. I mean, yesterday we had a rally.
There you go.
On the S&P. We were back up to 6,085 or thereabouts right now.
The 10-year near 430. Come on.
Yeah.
And the 10-year. Good to look at the bond market also. We are paying attention to that on open interest as well. Tomorrow, Morgan Stanley Chief U.S. Equity Strategist Mike Wilson joins us. We also have Brooke May of Evans May and Maddie Desner of the Capital Group.